my dear future chartered accountants. A very good afternoon to all of you. I hope my voice is audible and the PPT is visible. Then please confirm that voice is clear and the PPT is clear. Okay. So we are doing dividend adjustments. We'll do a problem based on that. Just a quick recap. Dividend yet to be paid, whether proposed or declared, we ignore for the purpose of examination, for the purpose because it's a non-existing event. Declared also will interpret as proposed and we ignore it. Dividend paid during the year need to be given adjustment, and the adjustment is while doing the P&L account analysis of profits, we add back, reverse, then we subtract in a working note as dividend paid to related to holding company share, we subtract in CONPL column. Related to NCI share, we subtract in NCI. And also we understood in some cases it can be considered as a recovery of investment under extreme cases. We did one basic problem also on that. But going forward, including this problem, we will not consider any way as a recovery of investments. We'll write a note if you want that if what would happen if you consider it. But while solving problem, we'll do as if it's not a recovery of investment because that is an extreme situation, definitely not required from exam point of view because there is alternative points exist on that. So we'll do a problem based on that. So A Limited acquired 8,000 shares in B Limited at a cost of 40 lakh on 1st of July 2015. The capital of B Limited consisted of 10,000 shares of 100 each fully paid. B Limited have paid. So B Limited have the policy of paying dividend in 2 times a year, which is 10% announced on 15 June every year and 15% announced on 15 December every year. Dividend is paid after 20 days from the date of announcement. So P Limited, P&L balance of B Limited on different dates are as follows. Date, amount, compute goodwill and NCI in a proportionate method for all the above years. Pass journal entries for each of the above years. Journal entries meaning with respect to the dividend payments. Regarding that, P&L and all we don't have to pass any journal entry. Regarding dividend payment, we will have to pass journal entry. In the books of the group. Okay. Because this dividend have been paid different tiers, what we'll do, we'll prepare one P&L account, simple T format of balance, format of P&L account, T format only. Like opening balance by P&L, current net year profit by net profit, dividend paid to dividend paid. We prepare simple in that format so that we'll get comfortable in that format, P&L account format. You can do other way also, but we'll write our T format, which we are used to it for so many years, we'll apply for calculating how the P&L account balance will apply over a period of time. Okay, let us just write it P&L accounts. For a period of years. So we'll just mention the dates, whatever the particulars, and amounts. Right side also dates, particulars, amount in rupees, just for our quick reference, not too much details. Okay. Sorry. P&L account balance they have given on 31st March 2015. 31st March 2015. By balance brought down. How much amount is going to be? 5 lakh. Opening balance given. Then 16, it became 7,50,000. All the closing balances we'll write later. So all the closing balances like 31st March 2016 to balance carried down given 7,50,000. Then 31st March 2017 given. Let us just write whatever given first. To balance carried down 12 lakh. Then 15 lakh, 31st March 2018. Okay. Okay, I think we need one more line because they pay dividend 2 times a year, no? So I think I need one more line. Okay, they pay dividend 2 times a year. So I've kept 2 lines for it. Okay, I think 2 lines is also sufficient, no problem. So this is what they've given. Opening balance 31st March 2015 and all other balances to balance carried down like a P&L account what you prepare. Okay. Now what information they said? The company is going to pay dividend 2 times a year. Paying dividend 2 times a year, which is 10% on 15th June. So we will write on 15th June every year to bank for dividend paid. Let's say 2 dividend paid. 15th June, it is one day, and 15th December. No, 15th June they announce it. 15th June they announce in 20 days. So in 20 days after 15th June means 5 days in July, 15 days in August. So 15th August they make a payment. Okay, 15th August. Okay, 15th August is a holiday. Anyway, that you don't mind. So 15th of every year it is announced, June 15th. Paid after 20 days. Paid after 20 days means 15 days in June and 5 days in 5 days in July. Oh, sorry, July. 5 days. So 5th of July. 5th of July, sorry. Yes, 5th of July. Not 15th, 5th of July. 5th of July. Because from June, 20 days means June we will have 15 days and 5 days in July. So July 7th it is paid. July 5th it is paid. 10%. 10% of capital. 10th of shares of holidays means 1 lakh. No, 10 lakh. On 10 lakh dividend the 10% means 1 lakh. Two dividends. 1. Let's say due to dividend 1 for our reference. 1 lakh. And another dividend is announced on 15 December, paid in 20 days. So December 15th means 15 days in December, 5 days in Jan. So 5 December 2015, not 16, 15. Uh, 5th of Jan 2016, paid 15 days later to dividend 2. How much paid? 15%. 15% on 10 lakh means 1,50,000. So this is for the year 2015-16. You get profit for the year, net profit for the year. You can compute as balancing figure. See how much you get, balancing figure. think 5 lakh you get? Fourth, fifth does not matter. That's for data first to reference. Don't worry about the date particular. That's not irrelevant here. You get 5 lakhs. Okay. So by profit for the year, balancing figure, you get 5 lakh. Okay. Similarly, next year, on 31st, or let's say 1st of April, you can say 31st or you can say 1st of April. 1st of April, beginning of the year, by balance brought down. Maybe even for this, you can make 1st of April so it looks neat. 1st of April 2015. So by balance brought down, opening balance looks neat. 7,50,000. And dividend paid, two dividend one. I mean, same 5th of July 2016, to dividend 1 lakh, and 5th of Jan 2017, to dividend 2 1,50,000. Okay, so what will be the balancing figure for the year 2016-17? Profit for the year. Again, balancing figure. Seven lakh, is it? 7 lakh profit for the balancing figure. Okay. Similarly, 1/4/2017, by balance brought down. Uh, 12 lakh. By 7/2017, to dividend 1 lakh. 31/3/2018, to dividend 2 1,50,000. So for the year 17-18, profit for the year. Balancing figure. By 1,50,000. Hope you got it. Date of acquisition, 1st of July 2015. Date of acquisition. First July 2015. And when is the first dividend received? As per our calculation, 5th of July 2015. Date of dividend received. Date of dividend receipt. 5th of July 2015. Then when is the announcement have been made? They announced it on 15th of June every year. So date of announcement. Date of announcement 15th of June 2015. So you can see date of acquisition is between the date of announcement and between the date of receipt. So therefore the investor is aware that this much dividend is going to be there. When the investor is aware and your dividend is there, which means when you make a payment, it includes an element of dividend as well. So it may be considered. So this dividend may be considered as recovery of investment. But for exam purpose, I told you, now onwards we will not do that. But I am writing a note so that you are aware of it. Usually, for exam purpose, we don't do these things. We will still take it to P&L account only. That's the simplest approach for examination. But I am just showing you this so that you are aware of the fact that this treatment also may be there. Some academy would have told you, some textbook would be there somewhere, so you should be aware of it. I just told you. Okay. Now, so based on these calculations, what are all the profits we have got? What are all the amounts we have got? Let's just break it up. Okay. So what are the data? I just told you. Okay. Now, so based on these calculations, what are all the profits we have got? What are all the amounts we have got? Let's just break it up. Okay, so what are the different amounts we have got on the balance? Okay, okay, let's do it. Balance as on 31st of March 2015. How much profits? Profit for the year we have 5 lakh. Opening balance 5 lakh. Then 2015-16. How much profit they made? Profit for the year. Profit for the year 15-16. What is the profit amount? 5 lakh. 5 lakh. But now this opening balance, we know it is pre-acquisition profits because it is opening balance. Acquisition took place on 1st of July. Now 5 lakh, you tell me, is it going to be opening balance or current year? I mean pre or post? 5 lakh will be during the year acquisition took place. So 5 lakh will be pre or post? 5 lakh will be divided into two parts, right? Divided into two parts. It's not just post. Acquisition took place on 1st of July. Acquisition took place on 1st of July. Don't the year will be divided on proportionate basis and 9 by 12. So this 3 by 12 whatever we get, that will be pre, and 9 by 12 whatever we get will be post. I think 1,25,000 is pre and 3,75,000 will be post. Then profit for the year 16-17 is 7,50,000 and profit for the year 17-18 it will be 5,50,000. No, 7 lakh. 7 lakh and 5,50,000, and these things will be post. These are the profits pre-post. I have just shown it to you. Okay, I think we'll just do in our regular working note format now. To prepare the working note formats, particulars amount, goodwill, Conpl, NCI. Whatever amount we computed, if you not taken out, don't worry. We will write in this format anyways. Goodwill 80%, Conpl 20%, NCI 20%. Okay, let's start with share capital 10 lakh, 80%, 20%. P&L account, what we just discussed now, 1/4/2015, 31st March 2015, pre. During the year, we do 3 by 12, 9 by 12. 3 by 12 is pre, 9 by 12 is post. The rest of them are all post. Please write down. Okay. Next, second dividend 1,50,000 paid, subtract in CONPL, subtract in NCI. Then year 16-17, 7 lakh. Again, you can distribute 80% to CONPL, 20% to NCI, and dividend paid 1, dividend paid 2. Please write it down. Hope you remember why are we subtracting in the CONPL column and NCI column. We are subtracting in the NCI column because that is the impact on group profits. To that extent it is distributed. So NCI balance coming down, so subtract. Why is it going to be subtracted in CONPL column? Because holding company share would have been taken to holding company's P&L accounts, and to remove the duplication, we are subtracting in CONPL column. Hope you are aware of it. Why we subtract in CONPL? We subtract NCI. Impact is very simple. We subtract in both. But the reason for subtraction is different. That you be aware of it. Because holding profits to the text. Why are we subtracting in the CONPL column and NCI column? We are subtracting in the NCI column because that is the impact on group profits. To that extent it is distributed. So NCI balance coming down, so subtract. Why is it going to be subtracted in CONPL column? Because holding company share would have been taken to holding company's P&L accounts, and to remove the duplication we are subtracting in CONPL column. Hope you are aware of it. Why we subtract in CONPL? We subtract NCI. Impact is very simple. We subtract in both. But the reason for subtraction is different. That you be aware of it. So please write down till there. Also we'll do it now. Once you're done, we'll again same treatment with respect to NCI column and CONPL column. and these incomes, remember these dividends will be transferred to the holding company's P&L account. So we don't have information of holding company's P&L, but holding company's P&L would ultimately come to con PL. These amounts, same amounts, 80,000, 1,20,000, all these amounts. So all these amounts coming from, these would be part of holding company P&L. Since we don't have information about the holding company P&L, we are writing only these amounts which will be included there. And this 80,000, if you consider it as a recovery of investment, we have written a note that will come here. Instead of coming in con PL column, it will come as an adjustment against investment. So only one column will change if you treat it as a part of holding company's P&L account. Anyway, write down till there. And please tell me the total, how much you get. Goodwill 1 lakh. And con PL 13 lakhs and NCI I think 5 lakh, right? Please see if the amounts are correct. And here it may look little nonsense to you that these amounts are subtracted and these amounts are added. Don't you think it's unnecessarily? Why are we doing this? You could have ignored this as it is. You're doing a minus in one, plus in another. Why are you doing so much? Here it may look nonsense to you, but in full-fledged problems, this will not be available separately. This dividend income, they will be implicit, including holding company's P&L. So these individual line items will not come in examination problem, full-fledged problems, because the holding company P&L will include these elements, but these things should be subtracted. Please see if you are able to get till here. Joint net assets account debit, goodwill account debit, to NCI, to cash, proportionate method. Net assets, we don't have specific information of assets and liabilities, so we'll do share capital method, which we calculated. This 10 lakh is share capital, 5 lakh the P&L account balance on 31/3/2015, and 1,25,000 profits for 3 months up to 1st of July 2015. Goodwill we calculate 1 lakh. Payment made 14 lakh investments. To NCI 20% of net assets. 20% of net assets. 3,25,000. Okay, next. Next transaction, dividend paid. First dividend received. I mean, paid means dividend received. NCI account debit to bank to the extent of NCI share. Dividend 1. And left holding company share, usually no entry will be passed. But if you treat it as a recovery of cost of investments, then goodwill will be created, comp will be debited. Hope you remember this. This we are not going to give the effect. But if you have to treat it like a recovery of investment, this will be the treatment. But we don't recommend this in exam, so I have given a red color here. If you treat like this, you pass this entry. Goodwill will get adjusted, otherwise that entry will not be there. Okay, next. Second dividend, that will be only related to holding NCI share. To the extent of holding company share, no adjustment will be there. To NCI account debit to bank. Okay, and for their 15-16, subsidiary company has earned profit, post-acquisition profits. So net assets like cash, bank, debtors like that. To CONPL holding company share 80%, to NCI 20%. Let me know once it is done. Okay, done. Very good. Let's go for next entries. Next year again 3 entries will come. Dividend paid 1, dividend paid 2, and profit for the year. So quickly write down, only related to outsiders, NCI to bank dividend 1, NCI to bank dividend 2, then net assets, the post-acquisition profit for the year 16-17. Next year 17-18. Also will be same thing, NCI to bank dividend 1, NCI to bank dividend 2, only related to the NCI share, and net assets to contribute to NCI. Okay, that's the overall treatment with respect to dividend. Let me know if you have any doubt, else we go further. Okay, hope it is done. Shall we go further? Okay, so come to this.
Problem number 43.
Problem now. From the balance sheet given below, prepare consolidated balance sheet under IND AS 110, share capital, P&L, trade payable, PPE, investment, inventory, trade receivables, cash in bank. AB Limited acquired 75% of XY 2 years ago when the P&L account of XY were rupees 500. On the date of acquisition, XY's property, plant, equipment had a carrying value of 1500 and a fair value of 3500, remaining life of 4 years. The group policy is to measure non-controlling interest at fair value on the acquisition date. The fair value of non-controlling interest in XY acquisition was 2600. An impairment review was performed on the 31st of March 2017, indicating that goodwill of acquisition had been impaired by 20% of its value. XY Limited paid dividend on 1/7/2016 at 20% of the profits out of the profits for the year 16-16. Both the companies have proposed dividend at 15% for the year 16-17. So two dividend adjustments are there. One dividend adjustment is proposed, the other dividend adjustment is paid during the year. So proposed dividend we will ignore. Dividend yet to be paid we don't consider. Dividend yet to be paid will be ignored. And dividend already paid will be considered. Will be considered. Okay. Just read the problem once more for 2 minutes. Okay, now let's first focus on the adjustments of this dividend treatment. Then we look at the revaluation profit, whatever we have. Okay, so analysis of profits. P&L accounts of subsidiary as on balance sheet date 6,500. We don't have opening balance, so let's just call it as on the date of acquisition, after acquisition, pre-post. On the date of acquisition. Okay, P&L we don't take 6,500. What we should do first? What we should do first? Whatever dividend already paid first must be reversed. So P&L 6,500 what we have plus whatever already paid. How much dividend already paid? 20%. Out of profit does not matter. 20% on what? 20% on 3,000. So that becomes 600. So dividend paid 7,100. Dividend paid 7,100. Total 7,100. Dividend paid 600. %20 of 3,600. Okay. So next you divide into on the date of acquisition. On the date of acquisition and after the date of acquisition. Okay. Now on the date of acquisition 2 years ago. What is the amount we had P&L? Group had a
500.
when the P&L account was 500. 500. Now look at the P&L now, 7,100. So what should be the after date of acquisition? It must be 6,600. So 500 is pre-acquisition profits and 6,600 is post-acquisition profits. Nothing else. All other adjustments like unrealized profit, revaluation, depreciation, everything later. Analysis of profits, only dividend to be added back, nothing else. Next we have revaluation treatment, fair value adjustment. We have PPE. So let's do as per subsidiary books. as per group books, net difference. Okay. Now on the date of acquisition, subsidiary had a book value, carrying value of 1500, and group books they are revalued at 3500. So 2000 difference will be a fair value adjustment. Then after acquisition, subsequent post acquisition, you are going to do depreciation. Have a useful life of 4 years. So divide by 4,500 divide by 4. But how many years are already over? It was acquired 2 years ago. So 2 years you multiply. I think you get 750. And here also 3,500 divided by 4 into 2. So 1,750. Differential, you get 1,000. Additional depreciation. And in fact, you could have done this directly, because ultimately this 1,000 is relevant for fair value adjustment. So directly if you do like this, 2,000 is for 4 years. How much for 2 years? You get 1,000 directly. So in the examination, you don't have to show this columnar format. If you want, you can show it. Okay, hope you got till here. Let's go for working out format. Have they given the percentage directly? How much percentage acquired? 75% acquired. Directly we know, straightforward. So particulars amount, goodwill 75%, corporate 75%, NCI 25%. Share capital 3,000, 75, 25. Subsidiary company first, P&L. Pre-acquisition we calculate 500, post-acquisition we calculate 6,600. is there, whenever revaluation comes, depreciation comes, and depreciation revaluation are two adjustments, then we have dividend adjustment, dividend paid will be subtracted. Anything else comes, revaluation will come, depreciation will come, dividend adjustment will come. In this problem, no unrealized profit. Anything else in this problem? NCI fair value adjustment, because NCI is measured at fair value basis. Amazing, very good. That one need to be there. So these are the things to be applied in this problem. So fair value adjustments, 2500, 2000 pre-post, it's only pre. Depreciation is post, minus. Fair value is plus, means depreciation is minus. Fair value is minus, means depreciation is plus. And NCI adjustment fair value we should do, and then we should do for dividend payment adjustment. So please write down till there. Okay, NCI adjustment, give a try. Let's see what you're able to calculate. Okay, so we have to calculate book value. So what and all we take? Share capital, yes. Pre-acquisition profit, yes, 125. Fair value adjustment, yes. Post-acquisition profit, we don't take it. Depreciation, we will take it. No, depreciation will not take it. This is frequently. Now one more is there. Dividend payment. Do you think dividend payment we should consider? Should I suggest for computing book value, for computing proportionate NCI? Should I subtract dividend? No, correct. Why? Because dividend is paid after acquisition. This dividend payment is after acquisition. So we are calculating the NCI fair value on the date of acquisition. Dividend comes later, post acquisition comes later, depreciation comes later, unrealized profit comes later. Share capital, P&L pre-acquisition, general reserve pre-acquisition, fair value adjustments. Okay, so proportionate for book value coming to 1375, but fair value is 2600. So NCI adjustment is 1225, and 1225, because fair value is high, it will be a plus in NCI, minus in goodwill. All of you got number? Very good, super happy, very nice. Okay, dividend payment next. 600 paid. Subtract from con PL for avoiding duplication. 450, 150 I think, no, not 450, 150. 450 for con PL, NCI 150. 25%, NCI 150. $750, then we'll come to AB Limited, holding company. is there, that is regarding the impairment. But impairment they said 20% of goodwill. So let's compute the goodwill first, then we'll do 20%. So investment you subtract entirely goodwill calculation, you get 2100, and impairment. Impairment will be transferred to ConPL. But this goodwill is also related to NCI because NCI is valued on fair value basis. So 20% of 2000 means 420 you get. So 420 will be goodwill column full amount, but ConPL column 75%, NCI column 105. We are distributing it because the NCI is valued on fair value basis. If NCI is valued on proportionate basis, the NCI amount would not have come, only ConPL amount would have taken the entire amount. Hope you are able to get till there. Please write down. And then holding company's P&L account also will come. P&L account of AB 14,000. Okay, total net amount, please tell me how much you get. Goodwill don't do from the beginning again. Goodwill you already calculate now 2100. So only adjust the impairment parts. So you get 1680 goodwill, 17435 ConPL, and NCI 3745. We don't add because the holding company's P&L not added back, correct? Why? I told you earlier, in the basic problem we added, here we don't add because the holding company's P&L account would have included already. When the P&L account of holding company is given to you, that is for the year, they would have already considered the dividend income. So 14,000 includes the dividend of 450. That's what I was telling you during the basics. The problem on what we done basics, we subtracted and we added. Why we added separately? There we did not have information about the holding company's P&L. Here we have holding company's P&L, and there also I told you, I reminded you. In full-fledged problem, I marked it and tell the under holding company, the dividend received will not come in con-PL column, because in the holding company P&L, this number P&L account of AP 14,000 includes all the dividend received. If minus and plus happens, then the adjustment requires nothing. That is nonsense adjustment. Why minus and plus? We could have ignored completely. This would have included here. That is why we are subtracting here. Duplication. That is not visible in the problem, but that is implied. Okay, hope you got the clarity. Okay, try preparing balance sheets. I hope by now you should prepare balance sheet comfortably. I'll give you 5 minutes. Please try it. Let's see if you're able to get it. I'll give you 5 minutes. Please try it. Okay, hope you're able to get it. Okay, let's see if you're able to get the number. Balance sheets. Balance sheet total 43,180, right? Okay, let me just give you the numbers, how it comes. For PPE, okay, so for PPE amounts are 12,000, 5,000. Profit of revaluation profit of 2,000, depreciation of 1,000. 12,500. $12,000 plus 5,000 plus a fair value adjustment of 2,000 and 1,000 comes from depreciation. Inventories and all is mere addition one by one. Uh, 7,000 plus 3,500. Trade receivables 6,000 plus 2,000. Cash and cash equivalents 4,500 plus 500. Share capital only from holding company, other equity working note, non-controlling interest working note, current liabilities 5,500 plus 1,500. Hope all of you got it. Now, come to this problem now.
Problem number 44.
A Limited acquires 1,600 ordinary shares of 100 each of B Limited on 1st July 2011. On December 31st, the summarized balance sheets of the two companies were given as below. Reserve on 1/1/2011 was 1 lakh and P&L of B Limited showed a credit balance of 30,000 on 1st Jan 2011, out of which a dividend of 10% was paid on 1st of August. A Limited credited the dividend received to its P&L account. The plant and machinery stood at 1,50,000 on 1st Jan 2011, was considered as worth 1,80,000 on 1st July 2011. This figure is to be considered while consolidating the balance sheets. The rate of depreciation on plant and machinery 10%. 10% means 10% per annum. So balance sheet is given. Prepare consolidated balance sheet of the group, assuming group is measuring at proportionate method. So no need of any NCI adjustment. Please try calculating the P&L account pre-post. Let's see if you are able to calculate it. Okay, let's see if you are able to get it. What is the amounts? Okay. Sheet reserve is what a balance of 30,000 on 1/1/2011. Let's use those information. Okay, so reserves opening balance given 1 lakh, no adjustments. Closing balance also 1 lakh, so current year 0. Technically we should divide this up to 1st of July. After 1st of July, 1.7 means don't get confused. 1st of July, date of acquisition. Date of acquisition. Up to 1st of July, after 1st of July, we need to allocate, but 0, so nothing to allocate. Let's leave at that. P&L account will do that. P&L account as on balance sheet date 82,000. We need to add dividend first. How much dividend? Dividend is paid at 10% on 2 lakh 20,000. Whatever the P&L balance, first step, whatever dividend paid is added back, and then you subtract into opening balance in current year. Opening balance given 30,000, balancing figure 2,000, and this will be divided in the ratio which this is December ending company. Acquisition took place on 1st of July. Therefore, divide on the basis of 6 months, 6 months. So you get 36,000, 36,000. So opening balance is pre-acquisition. Current year up to 1st of July is first pre-acquisition up to date of acquisition. And subsequently, it's going to be post-acquisition. Please write down this. Then we do revaluation calculation. And then as usual, we'll go further. Dividend I have added back to the P&L account. That's all I've done, nothing else. No other adjustments. That's what we have been doing so far in previous problem also. P&L 82,000 is the amount as per balance sheet. 20,000 is dividend paid. We add. That's all we did, nothing else. This 1,02,000 we divide into 2 parts. Opening balance 30,000, current year 72,000 balancing figure, and that is again divided into 2 parts. Up to date of acquisition is pre, after date of acquisition is post. It is 6 months, 6 months. Now, okay, so we know the format what we are going to do. Fair value adjustment, that is whatever PP we have, plant and machinery. We'll do as per subsidiary company books, as per group books, difference. On 1/1/2011, we had a plant and machinery which had a balance of 1,50,000, and we are acquiring on 1st of July after 6 months. Depreciation 10%. So less depreciation for 6 months. So 10% on 15,000 means 1,15,000, and for 6 months means 7,500. So WDV on 1/7/2011, date of acquisition 1,42,500. Then on this date, revalued as per books. What is the revalued amount? Revalued at considered as worth 1,80,000. 1,80,000. So difference comes to 37,500 is going to be our revaluation profit or fair value adjustment. Then less depreciation for subsequent periods. 6 months, same 7,500, not the revised amounts, and on 1,80,000 at 10% for 6 months means you get 1,80,000, 10% 80,000 into 6/12, 9,000 you get. So 1,500 is additional depreciation. $1,500, or shortcut, hope you remember. Alternatively, the difference between revalued amount and opening balance. If you do that, that also will give you same answer. Revalued amount is 1,80,000, opening balance is 1,50,000 multiplied by into 10% for 6 months. See if you get the same answer, 1,500. Okay, hope you got it. Okay, after this, regular working notes, that is particulars, amounts, goodwill, CONPL, NCI. Please prepare the format. Particulars, amounts, goodwill, CONPL, NCI. They have acquired 80%. They have acquired 1,600 shares. 1,600 shares out of 2,000 shares. From the balance sheet, you can see 2,000. Share capital divided by face value, that is 0.8 or 80%. Okay, look at how much is share capital. Share capital is 2 lakh. 2 lakh, divide 80%, 20%. Okay, some alignment issue is there. Give me 1 minute. Okay. Share capital 80%, 20%, 1,60,40,000. Reserves, we have done the calculation. Opening balance is 1 lakh, current year nothing, 0. P&L opening balance we calculate 30,000, and current year up to 1st of July, 6 months pre, and after 1st of July post, after date of acquisition, same amount, 36,000. We did 6.12, 6.12. We are using that working note. Okay, write down till there. Okay, let's do revaluation now. Revaluation we already calculate 37,500 in the nature of pre-acquisition, because this fair value takes place on the date of acquisition. So 80% goes to pre-acquisition goodwill column, 20% NCI column. Whenever revaluation comes, depreciation comes. Revaluation plus means depreciation minus, and depreciation is post-acquisition. So coming in con-PL column and NCI column as a negative number. Dividend paid out of opening balance, out of pre-acquisition does not matter. Dividend paid, simply subtract in con-PL, subtract NCI proportionately. No unrealized profit, you can go for holding company. Okay, holding account includes the dividend paid of 16,000, and that's why we are subtracting here. So don't include 16,000 again in con-PL column. No need to add that again. Account their reserves will come fully, their P&L account will come fully, and investments will be there in the goodwill column. Again, I repeat, this P&L account includes the dividend paid of 16,000, and that's why we are subtracting here. So don't include 16,000 again in con-PL column. No need to add that again. See how much amount you are able to get. Okay, let's see what goodwill you got. 17,200, yes. Con PL 3,08,800. NCI 83,600. Everything is perfect. Quickly prepare the balance sheet. Let's see if you're able to do. Take 5 minutes. And in case you're not able to get the amount here, please compare your numbers. Okay, so hope you got this one. Let's see balance sheet amounts. Let me just do a quick note on the PPE parts. So whatever the particulars, holding, subsidiary, consolidation adjustment, net. Net adjustment, let's say. Okay, land and building. Uh, 1,50,000, 1,80,000. 1,50,000, 1,80,000. Nothing with respect to adjustments. 3,30,000. Plant and machinery we have. Uh, 2,40,000, 1,35,000. 2,40,000, 1,35,000. Adjustment revaluation profit 37,500 I think, minus depreciation 1,500 I believe. So net amount comes to 2,40,000 plus 1,35,000 plus 37,500 minus 1,500. 4,11,000 and total 4,30,000 plus 4,11,000, that is 3,30,000 plus 4,11,000, 7,41,000. $7,41,000. Okay, balance sheet now. PPE, I just showed you 7 lakh for 141. Intangible assets from the balance sheet. Working note, sorry. Inventories, no adjustments were there. Simple addition. Inventories stock 1,20,000 plus 36,400. 1,20,000 plus 36,400. Trade receivables. You have debtors also, bill receivable also. Add on 44,000. I'll write here. Plus 40,000 plus bill receivable 15,800. 99,800. Cash and cash equivalent, simple addition 14,500 plus 8,000. 22,500. Share capital only from holding company. Other equity working note we have done. Non-controlling interest working note we have done. We have overdrafts. So I'm showing under short-term borrowings, overdrafts. Then trade payables, including bills payable will do. So 47,100, 9,000 and 8,400. 47,100 plus 8,400 plus 9,000. That will give you 64,500. Balance sheet total 10,36,900. See if you are able to do it till here. Hope the balance sheet tallies. The definition of happiness for CA students and commerce students. Let me know if you have any doubts. Do we classify financial assets and liabilities as per IND AS? Yes, we will classify. As of now, I just showed you as it is. You can show it for exam purpose. Here, anyway we have been doing it so far. I thought you would know it. That's why I'm not specifically told. You can do it. You can do inventories. Below that, you can do financial assets. Here also, you can do current liabilities. Below that, you can do financial liabilities. That's okay. Even in the exam, if you're not able to show also, it's fine for exam purpose. But if possible, you can show it. That's fine. Okay. Hopefully you got it. Let's go further then. Okay, let's go further. Okay, so come to this problem now. Come to this problem.
Problem number 46.
The following are the summarized balance sheets of PD Limited and SD Limited. Authorized, issued, subscribed, equity shares, revenue reserve, P&L, creditors, bills payable. Land and building, machinery, furniture, investments, stock, debtors, bill receivable, bank. PD Limited acquired 80% of the shares of SD Limited at a cost of 16,10,000. On which date fair value of NCI can be taken. So fair value of NCI, fair value method, at 5% below proportionate amount of controlling interest. 5% below proportionate amount of controlling interest. Controlling interest means 80%. To acquire 80%, how much you paid? 16,10,000. Now whatever do proportionately, because 16,80,000 represent 80%. Proportionately for 20%. That gives you proportionate amount. 5% below that. What could be the logic behind this? I told you, when you value controlling interest, you might pay more because you are getting the control. To get the control, you might pay some premium. Therefore, for non-controlling interest, it might be slightly lesser. That's what in this case 5% less is logical. It makes sense. On 1/4/2003, the reserves and profit loss accounts stood in the books of SD Limited at 50,000, 2,75,000 respectively, opening balance given. They have acquired on 30th of September and opening balance they have given. So during the year, we'll divide this into pre-post. Board of Directors of SD Limited proposed a dividend at 10% on 31st August for the year ended 31st of March. AGM for the financial year held on 5th of October and dividend is paid on 15th of October. Please look at the dates here. 30th of September 2003, date of acquisition, and Board of Directors proposed on 31st of August and dividend is paid on 15th of October. So you acquired in between the date of proposed dividend and date of payment. In between you acquired. So this may be interpreted as, what do? This may be interpreted as recovery of investment. If you interpret as recovery of investment, then you need to do a goodwill impairment. In this sense, CONPL should be subtracted and it should transfer to goodwill column. But we will not do for exam purpose, we will not do for this problem also. It may be interpreted, keep that in mind. Land building in the books of SD Limited at 16 lakh on 4/2003, revalued at 20 lakh on 1/10/2003. Furniture restored the books at 2 lakh on 1/4/2003, revalued at 1,50,000 on 1/10/2003. In both cases, the effects have not yet been given in the books. Prepare consolidated balance sheet of PD Limited and its subsidiary SD Limited on 31/3/2004, complying with requirements of IND AS 110. Okay, let's write a note on that one, then we go further. Okay, just write note on dividend payments. Note on dividend payments. Date of proposed dividend. When is date of proposed dividend? 31st October 2003. 31st October 2003. October? Sorry, August 2003. Date of acquisition. Of 30th of September 2003. Date of dividend payment. Uh, 15th October 2003. Since acquisition date is between proposed dividends and dividend payments, The cost of the investment includes the price paid towards dividends. In such case, dividend received by holding company may be treated as recovery of cost of investment, may be treated, in which case journal entry for impairment of goodwill will be what? Con PL account debits, whatever the amount, to goodwill. But we don't do it. We don't do this for exam purpose. It may be treated. Con PL account debit to goodwill means con PL column we subtract, in goodwill column we add, if you want to treat it. But we don't treat it, but it may be considered. It may be considered. One concept, one opinion, one school of thought exists. And different other set of people treat differently. But just for reference, I told you. But in this problem, we will not consider. Okay. Hope you got it. Okay. Let's do that revaluation computation now. But so what is going to be our treatment now? P&L account at the end of the year of subsidiary they have given. Dividend payment we know. We are going to add P&L closing balance plus dividend paid, reverse the effect. And then opening balance current year 2 more parts as usual process. And in our working note format, dividend payment will be subtracted from con PL column and subtracted from NCI column. Simple as that. Okay. Let's calculate revaluation calculation now. Revaluation and depreciation. So we have land and building. First we'll do land and building. As per subsidiary, as per group books, difference. Beginning of the year 1/4/2003. What is the land and building subsidiary? They said land building standing in the books of SD Limited at 16 lakh. 16 lakh. Revalued at on the date of acquisition. But what we have to provide to come to the date of acquisition from 1st of April 2003 till 30th of September 2003 for a period of 6 months. We should provide depreciation. In this problem, what is the rate of depreciation? Please tell me. In this problem, what is the rate of depreciation for land and building? What is the rate of depreciation for land and building? They have provided WDV only, so no information depreciation. Is there a printing mistake? They have provided WDV on 1/4/2003, opening of the year, but we require the WDV as on 1st of October. They revalued our book value, compare with revalue, then we get revaluation. Profits. When they have not given in the problem, you can't say there's a printing mistake. What you should do, based on the given information, make a reasonable assumption and do it. Fair value is 5% below proportionate. That is for NCI calculation. I am talking about land and building. That's for NCI calculation. There's nothing to do with land and building and non-controlling interest. No connection. So when they have not given anything, based on the data available, make a reasonable conclusion and you make a computation. So what do you do? In this problem, they have given the opening balance to be for land and building 16 lakh, and in absence of any information, what normally we assume, there is no purchases during the year, there is no sales during the year. Normal assumption. Look at the balance sheet. SD company, we have 16,20,000. So if 16 lakh should become 15,20,000, by assuming no purchases, no sales, the difference should be because of depreciation. So 16 lakh to 15 lakh 20,000 means 80,000. 80,000 divided by 16 lakh into 100, you get 5%. So when they have not given, please keep your eyes open and search where I can make a reasonable assumption and compute it. Okay, let's write down that. I'll just write above. Since rate of depreciation is not given, it is calculated by assuming that there are no purchases and no sales during the year. So rate of depreciation equals closing value minus opening value, that is depreciation basically, divided by opening into hundreds. So for land and building, rate of depreciation using this method, closing, do opening minus closing because depreciation will come anyway. So 15 lakh 20,000 is closing minus opening 16 lakh, you get negative, basically depreciation, that's why, divided by 16 lakh into hundreds, you get 5%. Don't write minus 5%. We know it is minus. Depreciation is minus only. For plant and machinery, what is the rate of depreciation? They have given stood at 2 lakh, and it was opening balance, closing balance 8 lakh. No? What? Sorry. Furniture. Oh, furniture, not plant and machinery. Furniture. Furniture is 1,60,000. Okay, 2 lakh became 1,60,000. Furniture. Sorry. Furniture. Uh, 1,60,000 minus 2 lakh divided by 2 lakh. Or you can do 2 lakh minus 1,60,000. So negative number will not come. Into hundreds, that is going to be 20%. Okay. So 16 lakh subsidiary. Group depreciation we just discussed at 5%. So depreciation for 6 months 16 lakh at the rate of, we calculated 5%. 5% for 6 months. So it will be 1,60,000. It will become 80,000. I think 40,000. So on 30th September 2003, it becomes 15 lakh 60,000 and revalued at 16 lakh, no, revalued 20 lakh. Revalued at 20 lakh. So difference 4,40,000. Fair value adjustment. This is on land and building. Similarly on, okay, depreciation we should provide. Less depreciation for remaining 6 months. As per subsidiary books will be 40,000 only. As per group books will be how much? On 20 lakh, 5% for 6 months. That is 20 lakh into 10, 2 lakh, 2 lakh, 1 lakh, 50,000 I think, 50,000. So difference 10,000 additional depreciation. Then additional depreciation. This is for land and building. Similarly for furniture, opening book value given in the problem to be 2 lakh, less depreciation 6 months at 20%, 20,000 on 30th September 2003, it becomes 1,80,000. Then what is the revalued amount? Revalued at 1,50,000. So 30,000 within brackets loss, fair value adjustment. $30,000 fair value adjustment. Then less depreciation at 6 months at 20%. On 1 lakh, that continues to be 20,000. And on 1,50,000, 20% on 15,000. So depreciation already charged. So you are having excess depreciation 5,000. 5,000 excess depreciation. Okay, see if you are able to get these things. What we should do here now, P&L accounts, adjustment, the dividend should be added back. How much dividends? Dividend at 10%. 10% of, don't write on authorized capital, 10% on paid up capital, 20 lakh, 20 lakh and 10%, 2 lakh. So 2 lakh dividend is added back, you get 4 lakh 80 and that you divide into two parts. Opening balance current year, opening balance given 2 lakh 75, balancing figure 2 lakh 5,000. Can I say 2 lakh 5,000 is pre or can I say 2 lakh 5,000 is post? I can tell both. Why? Because it is in middle of the year. So we divide this into two parts, 6 months, 6 months. 6 months is pre, 6 months is post. So opening balance is pre-acquisition. Current year, first 6 months is pre, second 6 months is post. Similarly, we'll do for reserves. Reserves advantage is no dividend treatment. Opening balance 50,000 given, closing balance from the subsidiary balance sheet 3,85,000. Balancing figure 3,35,000, divide into two parts, you get opening balance and you get current year. You get the amounts. Again, this is pre, this is also pre up to 30th of September and this is post. Please write down. Opening balance is 2.75 lakhs. Yes, that's the opening balance, no? Reserves. Reserves, correct. Changes. Okay. So they have acquired 80% given in the problem. Share capital 20 lakh, 80%, 20%, 80% goes to goodwill column, 20% goes to NCI column. Please write down. Okay, P&L accounts, opening balance, pre-acquisition 2,75,000 we calculated, 80 goes to goodwill column, 20 goes to minority interest NCI. Current year up to date of acquisition, that is for 6 months, it will go to goodwill column, balance 80% goes to goodwill column, 20% goes to NCI column. After 30th of September, after date of acquisition, second half of the year, we calculated post acquisition, 80% goes to CONPL, 20% goes to NCI. Similarly, reserves. Similarly, reserves. Okay. Now, revaluation profit we calculated on land and building, and depreciation is going to be post acquisition. Revaluation loss on furniture, and furniture we are going to have depreciation right back, revaluation plus depreciation minus, revaluation minus depreciation plus. What is the meaning of depreciation plus? They have transferred excess depreciation to P&L account, we have to remove it. Therefore, we are reducing the expense, we are taking back depreciation, writing depreciation back, adding back. Therefore, we are reversing depreciation, excess charged 5,000. We have done the calculation, so plus. And easy technique I told you, whatever happens with revaluation, depreciation is opposite. Revaluation is pre, depreciation is post. Revaluation is plus, depreciation is minus. Revaluation is minus, depreciation is plus. Very good. Other adjustments pending?
NCA.
Any other adjustment pending here? Can you think of it? Okay. Dividend paid 2 lakh, subtract 2 lakh, subtract NCI adjustment. We'll have to do it together. Please write down the dividends, then we'll do NCI together. Okay, let's do the NCI adjustment separately. What I told, it is 5% below proportionate amounts. So let's calculate that. Below proportionate amount means whatever paid by the holding company, 5% below that cost. That's what they meant. Let's calculate separately. Cost of investments by holding company. How much cost? 16 lakh 10,000. Number of shares acquired by holding company for that 16 lakh 10,000. How many shares? You acquire 80% means 1 lakh proportionate amount basically, which is how much? 16 lakh 10,000 divided by 1 lakh 60,000. 10.0625. Okay. Now they said 5% below that. NCI valuation 5% below. So 10.0625 multiplied by 1 minus 0.05. 5% less. 5% I'm subtracting. And then multiplied by number of shares. How many shares are held by them? 40,000 shares, right? Because 2 lakh shares were there. 1 lakh 60 is held by holding company. Balance 40,000 will be held by NCI. How much you get? Three lakh 82, 375, right? Alternatively, if you want to do direct calculation also you can do. 16 lakh 10,000 is for 80%. How much for 20%? Divide by 80% into 20%. Reflects proportionate amount and 5% below that. 5% below that means can I multiply it by 95%? Like a discount, 5% is removed. Remaining 95%. That also will give you 3 lakh 82, 375. Either of the cases you can approach. Working notes. Book value, please be careful. Quite a few adjustments are there. Share capital will take it. Share capital will take it. Pre-acquisition P&L will take it. Up to date of acquisition P&L will take it. Post-acquisition we don't. Opening balance, pre-acquisition reserves we take it. Reserves up to date of acquisition we take it. Post acquisition we don't take it. Revaluation profit yes. Depreciation no. Revaluation loss yes. Depreciation add back no. Dividend paid is after date of acquisition will not be considered. So 4 lakh plus 55,000 plus 20,500 plus 10,000 plus 33,500 plus 88,000. See, will it comes to 6 lakh 1,000? 6 lakh 1,000? Yes, fair value is less. So when the fair value is less, what we should do in NCI column? Since fair value is less, we will subtract in NCI column and we'll add in goodwill column. Fair value is less, the proportionate amount should be brought down. The NCI column presently showing 6 lakh 1000 amount, but we should make them 3 lakh 82. So reduce in NCI, opposite in goodwill column. Then go to the subsidiary company, a holding company, investments will be there, their reserves will come, P&L account will come. And if you treat dividend as recovery of investment, that will come here. If you treat, but we don't do it here. I'm just showing you for your reference. If you treat it, you subtract in CONPL, you add in goodwill column. CONPL account debit to goodwill, journal entry. But we don't do it here. I'm writing and cancelling it so that you know it will not be done in examination conditions. But if you want to do, this is the treatment. Only one line extra will come, that's all. Please write down till there and please tell me the totals. Okay. So you get other equity 18 lakh 2000, NCI 3 lakh 95 5 375, goodwill 10 lakh 2000, 10 lakh 12,000 625. And because you're getting positive number, it's not goodwill, it is capital reserve, gain on bargain purchase. And when you show it in the balance sheet, you will show how much 18 lakh 2000 plus 10 lakh 10,625. Total amount we will reflect in balance sheet. Sum of these two numbers. Goodwill 10 lakh 2000, 10 lakh 12,000 625. And because you're getting positive number, it's not goodwill, it is capital reserve, gain on bargain purchase. And when you show it in the balance sheet, you will show how much 18 lakh 2000 plus 10 lakh 10,625. Total amount we will reflect in balance sheet. Sum of these two numbers. Okay, let's prepare balance sheets. For balance sheet, let's do one working out on PPE because that quite a few adjustments are there. PPE, subsidiary, holding, adjustment or holding subsidiary. Let me write holding first. Subsidiary, adjustments, net. Land and building, holding company. We had adjustments we have done. 4,40,000 is fair value adjustment, and depreciation we subtracted, that is 10,000. So what is the net? $20 lakh plus 15.2 lakh plus 4.4 lakh minus 0.1, 39 lakh 50,000. Then plant and machinery, furniture we had furniture 5 lakh was there, subsidiary 1,60,000. We had a revaluation loss 30,000 and depreciation write back 5,000. So 5 lakh plus 1,60,000 minus 30 plus 5, 6,35,000. Then you have plant and machinery also, which has no adjustments, but that is also there. 20 lakh, 8 lakhs. 28 lakh. No adjustment. So what is the total? 3950 plus 6,35 plus 28 lakh. 73 lakh 85,000. Balance sheet then now. No adjustment of unrealized profit also. 3 lakh 40 and 1 lakh. Trade receivables. Your debtors also will receive also. No mutual OMSAI, I believe. 3 lakh 60 plus 2 lakh. Then plus 50,000 plus 40,000. You get 6 lakh 50 cash and cash equivalent. Again some simple sum, 2 lakh 40 and 80. Okay, see if we are able to get till here. Okay, hope it is done. Okay, let's come to liability side. Okay, equity share capital, simply only holding company. Other equity will be sum of gain on bargain purchase plus the con PL column. Both of them will be added. So which will be 10,12,625 plus 18,02,000. Ten lakh 12,625 plus 18,02,000. How much is coming to? 24,14,625. 28,14,000. 28,14,625. Okay, coming to the liability side remaining. Sundry creditors, bill payable, will add everything. 2,50,000, 2,25,000. Plus 1,10,000. So total you get NCI anyway calculated, trade payable 5,85,000. $5,85,000 and balance sheet total 87,95,000. Total okay. So we have done quite a few problems today. Good. Let's move on.